Hey, what's up, everyone? Welcome back to my world of stocks. We have another big wave of SEC filings pouring in from some of the biggest, richest institutional investors in the world, showing us which stocks they've been buying most recently. And in today's video, we're kicking it all off with the biggest, absolutely largest asset management company in the entire world, with the notorious BlackRock, who holds literally trillions of dollars in the market, and they purchased many billions more of dollars of stock this last quarter as well. So we're going to run through some of the largest purchases that they made in the quarter. I actually specifically pulled out the 5 largest increases that they made to their positions out of all their holdings, and I'm going to give you my opinion on each one of them, and I'll even rank them from best to worst to based on my opinion. So these are some of the stocks that they're the most bullish on. I'm going to give you my opinion on each one of them. So smash that like button if you want to support my channel. If you enjoy these videos that I make for you, thank you for that support. But let's just go ahead and jump straight into it, guys. All right, now sorted by percentage increase in these holdings, we have the smallest of the bunch first. We're going to start with the smallest, go to the largest later. But that was in advanced micro devices, ticker symbol AMD, which BlackRock increased their position on by only around 2%, yet that was still close to $400 million worth of purchases just in AMD stock alone during the second quarter. And for this one, I gotta say, I mostly agree with it. Now, I don't own AMD's stock myself at the moment, but I did used to own it several years ago for the reasons that I just always felt like they were the perfect kind of middle child between NVIDIA and Intel, as a great alternative option to what either of those two giants were selling in the open market on both the CPU and GPU side of things for computers, data center, gaming, and much more. Now, having said that, Intel and NVIDIA do still command the most market share for both of those categories. Of course, Intel dominating CPUs, while NVIDIA dominates GPUs. But what I've always argued about AMD, especially in the past, was that at their smaller size and market cap, was that they don't need to overthrow those kings. They just needed to stay competitive with them at more affordable pricing in order to steal some market share and get a piece of that giant pie. Because in reality, there is so much demand for these chips in the market right now, especially on the exploding rise of artificial intelligence, where companies are basically buying up every high performance GPU that they can even get their hands on. So if AMD can at least provide some of their own, and especially at more affordable price levels, then they should still see plenty of demand for them, especially from any companies that are on a tighter budget right now, which we know is the case for many of them out there, given all the macroeconomic challenges out there like inflation, interest rates, tariffs, and more. AMD, I feel, just fits very nicely into that slot there as a great alternative at more affordable levels. Now, don't get me wrong, I still think NVIDIA is going to be the king here long term, given how competitive the AI market has become. Companies are going to really need to buy the best performing chips and solutions that, of course, NVIDIA provides in order for them to stay competitive with each other. That's the reason why I moved my money over from AMD into NVIDIA. Of course, I've done very well on that. Anybody who owns an NVIDIA stock has done very well. I also locked in some giant profits on AMD stock. It's been one of my most profitable investments of all time. Same thing goes for NVIDIA. But my point is that because the market is so competitive, these companies want to compete with each other. They really need the best solutions. That's why I think they're going to opt for NVIDIA whenever possible. But with the market, and by the way, that's why you see some tech giants buying up literally millions of NVIDIA GPUs at times. But when you look at the overall market in terms of size, you're seeing these tech giants spend hundreds of billions of dollars on data centers, which will likely turn into a $1 trillion run rate per year. Well, there's just so much room here in this market for what I feel is multiple players, that you're going to see AMD, I feel, still see a ton of success going forward. And that's exactly what we're seeing. And that's on both GPUs and even CPUs. Like on the CPU side of things, Intel used to outsell AMD by a factor of 9 to 1 just a few years ago. But today it's only 2 to 1. meaning AMD has been stealing tons of market share. And look, that strong performance helped boost their total sales last quarter by a whopping 32% year over year to a new record high. And while data center didn't grow quite as much, it was still a double-digit increase too, and it'll likely get boosted even further down the road by their MI350 GPU chips, or AI accelerators really, that undercut NVIDIA's offerings by a whopping 30% on price. And that's something that their upcoming MI400 chips will likely look to expand much further on in terms of performance too. And so, as such, AMD's financials are expected to skyrocket in the coming years as they gain more market share, as they just, and the market itself just continues to grow. And that's especially going to be the case on the bottom line on when you look at projected EPS from analysts. Now, the only thing that I'm not super crazy about with AMD is the fact that the stock has already climbed by over 50% to right near a record high this year. However, it's also not too far off the levels that it traded for several years ago. And because of all the explosive new growth fueled by AI demand, their more forward-looking PEG ratio is actually 17% cheaper than the sector still, if you can believe it. I still like NVIDIA more myself, like I said before, but AMD is a great alternative pick here too. And so I'm going to rank them pretty high at number 2 until we see what else is on this list. Well, moving on to the next purchase, we have another fairly solid choice here. I know a lot of my viewers at least actually own this one, even though I don't personally have it myself, but it's one of the more popular retail stocks out there. That is the home improvement giant Home Depot, ticker symbol HD, which BlackRock added another close to $700 million more dollars of in the quarter. And yeah, as a leading home improvement retailer with fairly strong financials and consistent revenue growth, especially in the age of e-commerce and the whole retail apocalypse, although it's typically low growth at just like a single digit rate. But in terms of their business and demand and brand strength, I mean, if you're looking for any type of like hardware for your home, chances are very high that you're going to only one of two different physical stores for that. It's going to be Home Depot or Lowe's, as they're by far the most popular in that category. I will say, though, the main reason why I've never invested in either one of those is because of mostly Amazon. And that's not to say that you can get everything that you need from Amazon. In fact, I actually think one of the reasons why HD has been able to survive the whole retail apocalypse is because of some of their larger items that are not really ideal for shipping, like bricks and wood and carpet and all those types of larger things. It's often just best to kind of purchase at your local store rather than having to ship all of that. But when it comes to everything else, all the little stuff in particular, I just think Amazon is still the much more convenient and cheaper option to go with. Now, having said that, though, I also think HD has done a great job of expanding online too, where they're actually ranked as the 6th largest online retailer in the country right now. And they even have some new growth opportunities to look forward to as well, like in home automation and connected devices and installation services too. But overall, I still think that Amazon is going to be the better choice here. And even valuation wise, after climbing to about a record high, the stock trades way more expensive than the sector at around a 50% premium on forward PE and almost 200% higher by PEG ratio as well, which their tiny dividend of only around 2% is nowhere near high enough to make up for that super premium valuation. So I'm actually going to rank them fairly low here at number 4. I understand why people own it. It's for the stability and reliability of the stock, but as a little more of a growth or even dividend-oriented investor myself, it's just not something that gets me all that excited for owning. Next up, though, we actually have a very large biotech in Abbott Laboratories, ticker symbol ABT, which BlackRock increased their position on by over 3%, at close to $600 million worth. And yeah, for this one, I gotta say, as also a dividend-paying stock, I like it probably a little bit more than Home Depot. First of all, the business is solid and not likely to ever go away, as they're hugely important for the entire healthcare industry, operating multi-billion-dollar segments that make and sell all kinds of different medical products and services to some of the biggest markets in the space, including pharmaceuticals, laboratory, testing and diagnostics, nutritional, and more. During the recent pandemic, for example, Abbott was one of the largest suppliers of rapid testing, selling billions of those tests around the world. As such, This is a company that really saw its peak financials during that time, driven by the pandemic. But although sales did correct back down shortly after, they are now expected to return to growth once again, with analysts projecting record high sales in each of the following 3 years. Unfortunately, for anyone that didn't buy on any of the dips, though, the stock is also back up to near a record high, and more importantly, the valuation is pretty rich, with forward PEs that are around 30 to 40% more expensive than the sector, which, although the dividend has been grown for over 5 decades in a row, making this an actual dividend king, the small yield of only less than 2% is probably not going to be high enough to attract too many dividend seeking investors either. For that, if I was looking specifically for more value and a bigger dividend, I would actually much rather buy Medtronic stock instead, who I actually own myself. It trades much cheaper than both the sector and their own 5 year average, while the dividend has almost reached king status too, but the yield is also much higher at above 3%, which I think is overall just a more attractive option to have. In terms of ranking it though, I honestly feel like it's almost tied with Home Depot, but I think I'd give the slight edge here to About Laboratories because I think it's just a little bit more of an interesting business, and the dividend is maybe a little more attractive given that it is considered like a dividend king. All right, coming in at purchase number 4, though, we have a stock that I've always wanted to own myself. I've always actually really liked this one, but it's always just felt a little bit out of reach for me. But that is in the company Intuit, ticker symbol INTU, which BlackRock increased their position on by over 6%, adding over $1 billion worth during the quarter. And yeah, there's a lot to like about this one, especially business-wise, being an absolute leader in tax software like TurboTax, which I actually use myself, and I feel like it's a great platform overall. But more importantly, they've built off of that success by developing an entire ecosystem of other apps and services around it that just make the entire suite much more sticky, with things like QuickBooks, Credit Karma, MailChimp, and more that together offer a complete ecosystem of fintech solutions for not just consumers, but also businesses and even government and more. Plus, they even have a lot of future growth to still tap into, not just by integrating artificial intelligence into everything they do, but also even expanding globally as well. Also, at the moment, Intuit feels that they've only captured around 5% of their total addressable market. And because this is primarily a software-based company, I feel like they stand to not only grow their top line because of all the market opportunities still out there, but also expand heavily on the bottom line because of their software-like margins that they can benefit from as they scale up. As such, both their sales and profits are expected to soar in the coming years, with all of this alone really making it just a very attractive stock that I would honestly go ham on if the valuation was at least somewhat reasonable. But unfortunately, the stock has already climbed by over 700% in the past decade to right near another record high, which, don't get me wrong, I'm not completely against buying a stock just because it's a strong performer. I think that's actually a sign that the business is performing very well, and there's a lot to like about that. But when the valuation is significantly higher than the sector on virtually any metric you look at, which is the case here, I just feel that the gains are going to be a little bit limited at these higher price levels for the stock. Still, I do really like it, and even though the dividend is tiny, it's at least got some great growth metrics on it too. And I also just feel that this is, if I was like to go for a growth oriented type of like software fintech type of stock, this is absolutely one of the top choices that I would love to own. And because of that, I'm going to rank it pretty high here. I do like the valuation more on AMD though, so I'm keeping them higher at number 2, but Intuit is going to fit very nicely just under them at number 3, and then I'll move HD and Abot down one spot to fit it in, who I feel their businesses are a bit more boring compared to Intuit, who I like more. All right, though, guys, that's going to leave us with the last stock on the list. This is actually going to be a big bank in Capital One, ticker symbol COF, which was by far the biggest increase here by BlackRock at a whopping 80% increase, totaling well over $4 billion. But I'll just tell you guys right now, I'm going to keep this very short because this is easily my least favorite of the list, not because it's a bad company or stock. I think their financials are actually decent enough for what is primarily an online credit cards and banking type of company who's even one of the 10 largest in the country. but I just think that it's the most boring stock of the list. And it's also the one that I feel there are the most alternative options to choose from because of how many other banks are available in the market that I also happen to like more too. And although they do put up some decent growth at times, those growth rates can often be very volatile, especially for how slow moving of a stock this is. That despite trading near a record high, it's only up less than 200% in the past 10 years. And no matter what I want from them, I just think there are better options available, like Chase for the bigger size and strength, or US Bancorp for the bigger dividend and cheaper valuation, both of which I happen to own. And as such, COF is unfortunately going to get the last place ranking from me on this list, as again, I just have the least amount of interest in them, and I'll move the other stocks up one spot in order to fit it in there. But hey, there you have it, guys. These are my rankings. Let me know if you agree with them. Again, AMD is going to be my favorite here, but Intuit is another solid number 2 option. I don't own any of these stocks, but the top 2 especially would be ones that I wouldn't mind at all owning, especially if I can get them on a little dip here going forward. But AMD, I actually think, is still looking pretty attractive even at the current valuation. But hey, what do you think? Let me know down below what your thoughts are on this, if you agree or disagree with anything I said. But I hope you enjoyed the video, my friends. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.